Hello traders, welcome back to DMFX Trading Channel where we dive deep into Forex trading strategies and techniques to help you elevate your trading game. Are you struggling to spot profitable trade opportunities? Today I'll show you two powerful candlestick patterns, the dark cloud cover and piercing pattern, that can help you predict market reversals with precision. Whether you're new to trading or a seasoned pro, this video will give you actionable tools to sharpen your edge. Stick around, you don't want to miss this. Before we get into the specifics, let's quickly review candlestick patterns. Candlestick charts are a visual representation of price movements over a specific time frame. They show us four key pieces of data: the open, high, low, and close prices. Candlestick patterns like the dark cloud cover and piercing pattern give traders clues and help interpret market sentiment and potential price reversals. First up, let's talk about the dark cloud cover pattern. What is the dark cloud cover? This is a bearish reversal pattern that typically appears at the top of an uptrend. It signals that the bulls are losing momentum and bears are taking control. It comprises of 1. The first candlestick, which is a strong bullish candle, signaling an upward momentum. 2. The second candlestick is a bearish candle, which opens above the high of the first candle, creating a gap up. However, instead of continuing upward, the second candle closes deep into the body of the first candle, preferably 50% or more than halfway down. This indicates a shift in sentiment from bullish to bearish, making it a potential signal to sell. This pattern has multiple variations, as markets don't often express themselves by printing candlestick patterns exactly how we want them to. For this video, we will be looking at two variations of the dark cloud cover candlestick. From the graphic presentation above, the first day of this two-candle pattern signals bullish momentum, while the second candle signaling bearish momentum opens above the prior candle's session close or high, that is the highest point price got to on the candle's time frame for variation 1, and for variation 2 opens at the prior candle's close. However, by the end of the second day's session, the market closes deeply within the prior candle's real body for both variations. The greater the degree of penetration into the green candle's body, the more likely this is a high probability signal. Many traders misidentify these patterns by assuming any overlap between the two candles is valid. If the second candle doesn't close at least 50% into the body of the first candle, it's not a valid pattern. Next, we have the piercing pattern, which is essentially the bullish counterpart to the dark cloud cover. This is a bullish reversal pattern that appears at the bottom of a downtrend and comprises of 1. The first candlestick, which is a strong bearish candle, indicating downward pressure. 2. The second candlestick, which opens below the low of the first candle, creating a gap down. However, it closes deep into the body of the first candle, again, more than halfway up. This signals that the bears are losing strength and bulls are gaining control, making it a potential buy signal. And just like its counterpart, it has multiple variations, but we're looking into 2 for this video. The piercing pattern is composed of 2 candles in a falling market. The first candle is a red real body candle, and the second is a green real body. This green candle opens lower, ideally under the low of the prior candle for variation 1, and at the close of the prior candle for variation 2, but closes back deeply into the previous candle's real body. Moving on. How to trade these patterns step by step. 1. Identify the pattern in key areas. Traders often rely solely on the patterns without checking for confluence at important price levels. Look for the dark cloud cover at the top of an uptrend in a key level and the piercing pattern at the bottom of a downtrend, and make sure it forms at a resistance, support level, or Fibonacci retracement level, as these levels influence or increases its reliability. 2. Higher time frame trend alignment. Always make sure you trade these patterns in alignment with the higher time frame trend to increase its probability. And don't trade these patterns in a choppy or sideways market. They work best in trending markets. If you spot these patterns on the 1-hour time frame, make sure to check on the 4 hours time frame for the overall market trend. 3. Confirmation and entry. Confirmation comes from the second candle closing at or below 50% for the dark cloud cover, but must close above 50% for the piercing pattern of the prior candlestick. Secondly, entry. Enter on a pullback to 20%, 50%, or 80% to the resistance or support level of the pattern, that is the high or close, in order to reduce risk ratio depending on the size of the candlestick and place your stop loss a few pips above or below them respectively. Now let's look at examples on a live chart. Here, gold USD, the market was trending upwards, creating higher lows. Upon reaching our marked-out resistance zone, the market printed a dark cloud cover candlestick pattern, signaling an opportunity to go short. Now, we place our sell limit at 20% of the last candlestick to reduce risk, and place our stop loss a few pips above the pattern to account for market volatility. We target the next major support for take profit and watch the market play out. Our limit got triggered. Don't forget, as I always advise, manage your open positions and secure partials if necessary. Eventually our take profit was hit. Let's look at another example. Here the market on gold USD was in a downtrend. Upon reaching our support zone, variation 2 of the piercing candlestick pattern was formed, signaling an opportunity to go long. As usual, we place a limit at 20% of the last candle of the piercing pattern to reduce risk and watch the market play out, managing our open positions accordingly. Eventually, our take profit was hit. Finally, to wrap it up, the dark cloud cover and piercing pattern are incredibly useful tools in a trader's arsenal, but like any strategy, they're not foolproof. Always combine them with other forms of analysis and practice good risk management. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon so you never miss an update. Let me know in the comments. Have you used these patterns in your trading? What's been your experience? Thanks for watching, and happy trading.